Hi, this is Karen Lin. Welcome to week 5 of financial accounting. In this video, I'm going to introduce chapter 6, cash and cash equivalents. In accounting, cash does not only mean the coins or notes that you have in a bank or in your wallet. So it refers to the currency, coins, your bank checking accounts, and the bank saving accounts. So when we talk about cash, it's not only the paper cash in your wallet. There's another concept called cash equivalent. Cash equivalent are accounts that equivalent to cash. For example, low risk investment that can be converted into cash. There are two examples of cash equivalent that are certificates of deposit and treasury bills. I'm going to focus on two main points of this chapter. The first one is the notes payable. So in this example, the company borrowed 12,000 dollar cash for 90 days on June the 16th, and it will be paying back the principals, which we call the borrowed money principals, on September 13th. How does that affect our company? Obviously, cash increases because we borrowed money, and liability increases as well. That's notes payable. One related question to this is that how do we calculate the cost of borrowing cash? Because everything comes with the cost. You don't use the money for nothing. So when we calculate the cash of borrowing this cash for 90 days, we need to answer two questions. One, what is the total cost of borrowing? Two, how much should we recognize in June as an expense? So when you are watching your video here, you should pause your video and think about these two questions. What are your answers? Now, the total cost of borrowing is basically the interest. So if you borrow money, if like mortgage or loan from the bank, you pay interest, right? So how do we calculate interest? It is the principal multiplied by the annual interest rate and multiplied by how many days that we are using the loan. So if we look at the information section, we are using the loan for 90 days from June the 16th to September the 13th. So total cost of borrowing will be 90 days out of 365 days because this rate is an annual rate, which is a 1 year. So 1 year rate is 10% divided by 365. That means daily rate, right? And then multiply by 90 days. That means how much interest you're paying for 90 days. So the total cost of borrowing is 295.989. Remember, we talked about expenses recognition. We don't recognize all the cost of borrowing as interest expense in June, because in June we only use the loan for the days between June the 16th to June the 30th, which is the last day of June. So if we calculate that, that is 15 days. Okay, how do we calculate the intervals between the two? 2 days, it is 30 days minus, so it equals to 30 days minus 16 days plus 1. So why do we plus 1? It's because that's when we are talking about the two intervals, we need to include both days of the the beginning of the day and the date and the ending date inclusive in the interval. So we need to adding 1. So mechanically, it is the ending days 30th minus the beginning day 16th plus 1. You can also count your fingers. You will get the same number, which is the 15 days. So that because the total cost of borrowing out of 90 days is 295.89, so 15 days cost, it is 15 out of 90 multiplied by the total days. You could also use this original formula, but change this to 15, okay? So it will give you the same answer. Now, if you think about every month, in June, you should recognize interest expense $49.32. In July, we are using the loan for 31 days. That's July the 1st to July the 31st. So that's $101.92, so on and so forth. For the total 90 days, it is $295.89. All right, so when we are paying back the loan, we would be paying back cash, which would be consists of the principal and the interest. Okay, there is notes payable and interest payable. We are paying them together. So in the past, if you are not familiar with two accounts in the debit side and one account on the credit side, this is a good chance that you understand that when we record our transaction, we may have multiple accounts on the debit side or the credit side, but as long as you have them added up together to be the same amount. Of course, each journal entry should be related to one transaction. Okay, you cannot mix 10 transactions, for example, and then write multiple debit side, multiple credit sides and call them journal entries, because if you are doing that, it would be very difficult for you to trace back which entry goes to which transaction. Okay, so that's the first point I'm going to talk about, notes payable and how to calculate interest in and recognize the interest expense in a certain month. The second point I'm going to talk about is bank reconciliation. So one way we control cash is that we deposit cash in the bank and then have the bank help us to verify the balances that we have. However, there may be times that the bank and our records are different, and we need to reconcile both records. Before I start to talk about the reconciliation, I just want to mention that the bank and the firm are two separate parties. So the bank actually records the cash and it receives, and the company records the cash it deposits to the bank. So for this part of the contents or materials, you need to refer to the book or our lecture notes to understand that bank has a set of accounts that will record the company's deposit to the bank, and the company has another set of accounts to record its cash. Okay, so there may be times, as I said, the bank statement deviates from the company's checkbook. There may be two types of reasons why they are different. One is that there may be a mistake. So the bank may make a mistake when they're recording the transaction. The firm may make a mistake when they are recording in their checkbook. So if either party makes a mistake, these two records won't reconcile. The second one is that there may be a timing difference. For example, the firm deposit a check in the bank at the end of its accounting cycle, say December 31st. The bank didn't receive the check until January the 1st. If that's the case, obviously the company is going to record a deposit, but the bank wouldn't have it until the next cycle starts. So when the firm got the statement cutting off at December the 31st, it would have a different number from the bank's checkbook. So let's take a look at one very simple example. Let's assume Lowell Company has a bank account at the Lawrence National Bank. Okay, on July the 2nd, both the bank there are $6,000 of cash that's deposited by Lowell. And Lowell shows it's on its checkbook, there are $6,000 of cash. Okay, this is similar to in your own checkbook, you record say $100, and if you open your app on your phone and go to, for example, BOA, and you go to the app, it shows another 100. Okay, so again, let me say it again. It's just like on your checkbook, you have recorded $6,000 cash that belongs to you. when you open your BOA Bank of America app, it shows that you do have 6,000. So these two sets of records, they reconcile. They are the same. You'll be rest assured that you have the money that will come back and you could use it. Let's assume on July the 5th, Lowell Corporation received $800 cash. It's a check from the customer. So Lowell Corporation deposited the check in the National Bank at 4:30 on July the 5th, right? But this check that wasn't processed until July the 6th, when the Lawrence National Bank processed the check. So when Lowell Company recorded this transaction, Lowell Company would show the beginning balance of $6,000 cash. It would debit cash, right? Because it's receiving money from the customer. So debit cash, credit revenue, okay? Whatever that revenue is. So this all other accounts, it's just a simplified version of everything else. It is basically, in this case, it's revenue. So you debit cash, credit revenue, then Lowell's account shows $6,800 cash. However, the bank didn't show, you can see the bank didn't show the 800 until July the 6th because Lowell's account deposited the check at the end of the business day. So the bank didn't record this transaction until the next day. Okay. And notice that the bank has cash account. It deposited this $800 cash on July the 6th, and then credit customer deposit, which is a liability for the bank, $800. Okay, whenever a company deposit cash in the bank, it becomes a liability of the bank because bank has the cash, but it owes the customer. Whenever the customer, which means in this case Lowell, needs to withdraw the cash, the bank has to provide the cash, so it is a liability to the bank. In this case, in another point is that the Lawrence National Bank actually has a subsidiary account, which means in here when we look at cash and customer deposit, it's a pool account of everybody. So we don't know how much belongs to Lowell Corporation. So this $960,000 cash, it's a pool of cash of every customer that the Lawrence National Bank has. But in a subsidiary account, the National Bank has a lot of subsidiary accounts about its customers. We pool everybody else in one account, one T account, just for simplicity, for showing purposes. That's one T account for all companies other than Lowell. Actually, in practice, it is like hundreds, thousands, of millions of accounts, just like the Lowell account. Okay, so this is just for simplicity. And you can see we single out Lowell Corporation and make a separate account for Lowell, which is the same for everybody else. So the bank has recorded Lowell has a beginning balance 6,000, which was shown a moment ago. It is the same between the bank and the firm. So Lowell has $6,000 in the bank. Remember, this is the bank's account, and the bank received Lowell's $800 on July the 6th. At the end of July the 6th, the bank records $6,800 for Lowell Corporation. Now, if Lowell on July the 5th trying to look at its BOA app, right, it would find that the bank only has $6,000 cash for Lowell. However, Lowell has $6,800, right? Because Lowell already recorded it. Let me go back to the T account again. So July the 5th, Lowell already has $6,800. But if you look at the bank only has 6,000 because this is one day later.